Hey Raj, before you even think about paying yourself, you need to understand something important. How you get paid depends entirely on your business structure.
Wait, I thought I just take money out whenever I want.
That depends. If you're a sole proprietor, yes, it's simple. But if you're in a partnership or corporation, things get more structured.
So, what are the main options?
Three main ones. Sole proprietors take draws, partnerships use draws with tracking, and corporations use salary, dividends, or both.
Sounds like corporations give more options.
Exactly, and more planning opportunities too.
Okay, let's start simple. How do I pay myself if I'm just starting alone?
As a sole proprietor, you don't pay yourself a salary or dividends, you just take money out. That's called a draw.
So, if I take less money, I pay less tax?
No, that's the biggest misconception. You're taxed on profit, not withdrawals.
Wait, even if I don't take the money?
Exactly. CRA doesn't care what you withdraw, they only care about your business profit.
What if I start a business with a friend?
Then you're in a partnership. You still don't take salary or dividends, you take draws.
So, same as sole proprietor?
Not quite. Now you're sharing profits, so things must be tracked carefully.
And taxes?
You're taxed based on your share of profit, not what you withdraw.
You mentioned tracking. What exactly are we tracking?
This is where capital accounts come in. They track contributions, profit share, and withdrawals.
Why is that so important?
Because profit and cash taken are not the same. Capital accounts show what each partner is truly owed.
So, if I take more money, it affects my balance?
Exactly, and that can create issues if not managed properly.
Okay, corporations sound more complicated. How do I get paid there?
Now you have options: salary, dividends, or a mix of both.
What's the big difference?
Salary is paid before corporate tax and is deductible. Dividends come from after tax profits.
Which is better?
Neither is always better. It depends on your situation.
So, how do I decide between salary and dividends?
You don't copy others, you look at your own situation.
Like what?
Family, other income, retirement goals, CPP preference, and RRSP needs.
So, it's not just about saving tax.
Exactly. It's about long-term planning.
Alright, but how much should I actually take out?
Start with your lifestyle. Your expenses determine your income needs.
So, taxes come after that.
Yes, build your tax strategy around real life, not the other way around.
What else matters?
Cash flow, business growth, and retirement planning.
Can you simplify salary versus dividends for me?
Sure. Salary gives you CPP and RRSP room. Dividends give you flexibility.
So, same money, different impact.
Exactly. Same cash, but completely different long-term outcomes.
This feels more like a mindset decision than just tax.
That's exactly right. Salary is structured and disciplined. Dividends require self-discipline.
Meaning,
With dividends, no one saves or invests for you. You must do it yourself.
so risk is higher.
Yes, but so is flexibility.
Is there a simple way to decide?
Yes, ask yourself key questions.
Like what?
You want CPP? Then salary. Want our RSP room? Salary. Need flexibility? Dividends.
What about family involvement?
Careful, TOSI rules can tax dividends at high rates if they're not active.
Let's say I choose salary. What do I actually do?
You run payroll. First, decide your gross salary.
Then,
Open a CRA payroll account, calculate deductions, pay yourself net, and remit taxes.
sounds strict.
Very. Miss deadlines and CRA will penalize you quickly.
What about dividends? Are they easier?
Much easier. No payroll, no monthly remittances.
So I just take money?
Yes, but you must track everything and declare it at your end.
Any catch?
Big one, no tax is withheld. You must save for taxes yourself.
What happens at the end of the year?
Everything must be reported to CRA.
What forms?
Salary uses T4. Dividends use T5.
Which is more complicated?
Salary, because it requires reconciliation. Dividends are simpler.
Deadline?
End of February, don't miss it.
Wow. This is a lot. What should I really remember?
Keep it simple. Your structure determines how you get paid. Profit drives taxes, not withdrawals. Corporations give flexibility. Salary versus dividends affects your future. And most importantly, your strategy must be personal.
So this isn't just tax. It's life planning.
Exactly. That's what separates a tax filer from a true advisor.